Welcome our visitor to Wealth from Walls. This is a monthly podcast that's dedicated to empowering you and safeguarding home buyers and investors in their pursuit to create wealth through property. So join us as we provide expert tips, strategies in finance, in law, in property to assist you in achieving extraordinary success in your property journey. So welcome everyone. We've done our introductions, I'm sure, from the first episode. So I do encourage our listener to look at our other episodes that we've done before today. This is our third installment. And we have a fantastic guest joining us today. We've got Angelo Baronessa from Divergent Wealth, a fantastic financial planner. He's assisted me personally. And I can attest to his amazing work. So thank you, Angelo, for joining us today.
Thank you. Appreciate that. Kind words.
Very good to have you on board. So the first person, though, I'd like to pan to is Mohit. So Mohit, you're an amazing mortgage broker. We all know that. We want to know what's happening in the market at the moment. What's happening in the mortgage market?
Thank you, Melissa, and good morning, everyone. So excited to be here. What's happening in the mortgage market? Well, I think it's no news that RBA put a pause on the cash rate hike on this Tuesday again, which was yay movement.
Yay! We needed that.
All the borrowers. It's giving us the signs that the inflation is declining, although slowly, but it is heading in the right direction, which is what we all wanted, right? Now, RBA Governor Philip Lowe, he was saying that our inflation, the target inflation is between 2 to 3%, and currently we're sitting around 6% mark. So we still got a fair while to go. They're expecting it to be in that range by the end of 2025. So still a fair bit to go, but at least we're heading in the right direction, which is a great news. And I was just looking at some of the history as well. Now, can you believe since May 22, there have been 13 rate rises, right? Almost about 13 months. So that rate rises have been around 400 basis points. That's a massive number. When you convert that into mortgage terms, on a standard $500,000 loan size, 30-year loan term, you're looking at an increase of about $1,200 per month. That's gotta pinch your pockets, right? It's a massive number. So hopefully the numbers will start stabilizing and then decline eventually. Which brings me to my next point: has the cash rate peaked? And I think the outlook from the economists hasn't vastly changed since last month. They were saying that there's still one or at least two rate rises this side of the year. And I think that's still on the card. That's personally my opinion, based on what I'm hearing from other economists. So they're expecting it to sort of maybe one or two rate rises this side of the calendar year. And then from next year, it will start stabilizing. And then from mid next year, hopefully the rates will start sliding down slowly. This is no doubt is having a massive impact on the property buyers as well. And we'll get your take on it in a little bit as well, because we certainly are seeing a drop in first home buyers activity. Now, new loan commitments, they were down by 0.8% month on month and 12% down compared to same time last year. That's a massive drop. And that's what first home buyers are seeing. Melissa, I'm sure you would be seeing the same thing from convincing point of view as well, that people are just scraping wherever they can just to get in the market. But on the, sorry, you
I agree with that sentiment. Yes.
Yeah, 100%. And it's industry-wide sentiment at the moment, which is quite challenging. On the other hand, refinancing, that's still on the rise. In the month of June, nearly $20 billion worth of mortgage was refinanced. Now that was about 12% high compared to same time last year. So whilst the first home buyers activity is dropping, refinancing is rising, and for valid reasons as well. Everyone wants to save every single penny they can, so they're doing everything they can to maximize on the returns from the mortgage and getting the right values. You might remember from our earlier presentation as well that there's about 35% of mortgages which are fixed. They are running off this year. They're calling it a cliff period, which is a very interesting time, because you're coming out of 1.92% interest rate kind of amount, and then all of a sudden you're going up to 6.5%. Which means when your interest rates rise, your borrowing capacity drops, which means you may not be able to service your loan to refinance. And that's why we find a lot of people in a mortgage prisoning situation. So it's a good initiative that some of the lenders have taken to give relief to people who might be in a mortgage prisoning, where they will only apply a smaller amount of buffer, say about 1% in their assessment rate, as opposed to 3%. Now you might think it's only 2% difference, but let me tell you, that makes a massive capacity. And that's a great news for people who may think that I may not be able to refinance. Have a chat to your bank, have a chat to your mortgage broker, reach out to us, because there are certainly lenders who are more lenient towards the assessment rate. Because once you roll off the fixed interest rate, if you don't do anything, you automatically go on the variable rates. And those variable rates can be quite high. So cost of doing nothing can be tremendous. So pick up a phone, give a call to your broker, to your banker, and see what are the options out there. Right? And that's where the broker value proposition comes in as well. Like, we've got access to more than 60 lenders in our panel, to cater for almost all the credit circumstances that are there to help the clients in their need. So don't be shy. Pick up a phone, give a call. That's my message for today. So from here, I'm going to lead on to you, Amir. What are you seeing in the property market? Are you seeing a lot of stress selling, people wanting to buy, their dream investment property or dream home in a dream location, but they may have to compromise with certain factors? What are you seeing?
Look, it's very interesting times. You probably heard the news. The property market is going through some changes with a surge in listing by investors. With mortgage costs going up, it is causing some property investors to think twice about staying in the market. For example, in Sydney, the number of investor-owned listings hit a record high of 40% just last month. And it is not just Sydney. The trend is happening in other cities like Melbourne, Brisbane, Perth, and Darwin too. On the flip side, Adelaide and Canberra have seen a slight drop in investor listing, which is interesting, right? It is definitely something that's caught the attention of many in real estate industry. Eliza Owen, the head of research at CoreLogic, has been shedding light on this situation. She explains that investors who purchase at top of the market with higher mortgages are feeling the pressure of increased financial burdens, leading them to list their properties for sale. In certain suburbs, particularly in Perth, like Northbridge and Highgate, the number of ex-rental listings has shot up, accounting for more than 71% of all new listings in June. And in Sydney, areas like Stanmore, Forest Lodge, and Parkley have seen a significant share of investor-owned listing. The cash flow shortfall is becoming a major concern, with Stanmore alone experiencing an alarming $4,100 per month deficit. Let me be clear. This is a critical time for property investors. They can either find great opportunities or invest in high-risk areas. In the face of rising mortgage costs, as Mohit mentioned, the importance of conducting due diligence, and making strategic decisions on suburb selection cannot be overstated. Purchasing at suburbs with high mortgage stress should be avoided at all costs, as purchasing in these suburbs can hinder capital growth significantly. There are plenty of suburbs out there that are experiencing significant growth right now, some as high as 13% in the last quarter. So it is all about knowing where to invest and how to invest to secure high-performing investment properties while managing risk effectively. So the key for investors is to understand the optimal purchasing price, manage cash flow effectively, evaluate the potential to sustain a property during market turbulence, and avoid high-risk suburbs. I won't lie, the real estate landscape can be pretty complex and filled with uncertainties at this time. That is where experienced property advisors comes in. They can be a real lifesaver, guiding you to make informed decisions that lead to a profitable outcomes, even in this current market condition. So stay informed, stay strategic, and you will find there are great opportunities out there. Remember, every market condition presents its own unique set of opportunities. So I talk about risk and opportunities for property buyers. Part of risk management that every investor or home buyer should consider is reducing the risk in unforeseen situations, such as a death or accident that leaves them unable to work anymore. So such situation can easily put the investment in danger. So Angelo is the expert in this area, so I'm gonna ask him the question. Angelo, can you please share with us the strategies that can be used by property buyers to protect themselves against these type of risks?
Yeah, of course. Look, insurance is a dirty word. I'll start off with that. So I know a lot of people get all wound up when you say insurance. So let's not call it what it is. Let's just call it what it does. It protects. So it's all about protection in this case. It's quite vital, especially when we're talking about your family home, for example, or even your properties. I mean, as I tell my clients, we're building up your wealth. We're building you up to a position where you want to be, because these are your goals. And if your goal is to be at a certain point at a certain time, there's no point of putting everything together. We've worked so hard to get there, and then one thing unravels the whole plan. So there's no point of trying to even attempt to get to that point. So always make sure you've got a safety net. And for most, the safety net is, I've already got that, it's inside of my super. But the question then becomes, well, what do you actually have inside of your super? Because a lot of people get their statements, don't know what it means, or don't realize that they may or may not be protected for what they think that they have. So don't put your head in the sand, have a look, dig up your statement, call up your fund. If you've got an insurance policy you're paying for yourself, double check what that is, because protection comes in a whole bunch of forms of death, disability, major illness, and that's a really vital one, and protecting your income. So just as a general warning as well, this is just general advice, nothing considering your goals, your objectives and whatnot. So don't take this as, of course, advice. Always seek professional advice, and that's where people like me sort of come into the picture. So say, for example, we'll give you a stock standard scenario where mum and dad have a property. I guess the average mortgage in Victoria is sitting somewhere about 500,000-600,000 these days. Average insurance within your super fund, and this is just across the board, without having done anything, is about $150,000. So already we see that there's a huge gap between, if I were to pass away, what actually happens, and what actually does happen is a really important question to ask. Well, if you've got mum and dad, one passes away, who looks after the kids? Who then has to take the kids to school, sports, and so on? Who then has to take on extra work? And you've already got your headphones on, so you might be, having to DJ on the side or something. So what do you need to do in that case to make sure that you can keep up, those living expenses? you know, again, what's in your super fund or what are you actually paying for? Income protection doesn't come with every single one of them. And you might have the bare basics. So some of them come with $1,000 per month. So 12 grand a year, and that's your income for the rest of the year. Yep, it might be short-term disability, so you're going to get 12 grand for a few years at most. And then what? And then what happens? So if your plan is, well, I don't know, then have that conversation. You know, don't put your head in the sand, because you can craft ways where it is tax deductible. You can have ways where you get a discount because of the tax structures. These are really cool things that people can do that, you know, really excites me, because I have seen them work. And I'll give you an example. I haven't told anyone this yet, but the other day I got a phone call from a previous boss, and he said, just to let you know, that client that we worked so hard on to make sure that they did take out the insurance policy, they're claiming for it now, because they've now been diagnosed with an illness that they can claim on, and it's going to change everything for, you know, that client. And the sad case, or the sad scenario in this was, she became widowed as well. So she actually received a lump sum from her husband's life insurance and has to live off that. So we had to make sure that she could meet her goals based on the fact that her husband passed away, the main income earner, and now she is the one who has to go to work as the family's, you know, grown over the past few years. But that's never been a conversation about insurance. It's been a conversation about protection, because we're protecting your wealth, we're protecting the kids, we're protecting your income to make sure that if anything does happen, you've still got the ability to pay, you know, the mortgage, to pay for the school fees, to pay for your living expenses. It all comes into play. So not a conversation about what insurance you have, it's a conversation about what protection you have in place should anything happen. Which is, look, I see it day in, day out. I've seen so many claims come through, so many scenarios play out, but have that conversation, pick up the phone, send me an email, whatever it takes, because you don't want to be caught out in these scenarios. But I guess I've talked a lot about protecting on one side of it, which is about the risk management. But Mal, I've got a question for you. How can you protect yourself legally in these scenarios?
Yeah, very important question. You can never do enough due diligence when you are in the market. So the due diligence, or the timing at which you do the due diligence, should always be before you buy. So that's the number one principle. So if you find something in the market that you do like, for example, you've gone in, you've had a look at it yourself, you don't just buy there and then. It's really important that you take a number of steps to protect yourself, because staging, when a property is staged, it's there to entice you to buy, but there are certain considerations that you need to be thinking about and doing before you actually buy a property. So yes, if it makes sense commercially, that's a tick, but does it make sense legally? So some tips that I can give is basic 101, get the contract looked over. So when you do find something you like, one of the questions you should ask the agent is for a copy of the contract and the Section 32. And the Section 32 is a disclosure document that has a number of certificates and information about the property that a seller is required to disclose to you about it, that we review as well. So that's called a Section 32 statement. We look at that with the contract to see what is the level of risk. Is there any unfair terms that are governing this transaction? Is there anything particularly risky that's being disclosed by the vendor in either document or both? And how do we manage that risk? And getting the contract looked over before you buy is a fantastic opportunity for you to make a more informed decision about what you're buying, and also to give you at least the ability to try and negotiate any changes before you buy. That's the perfect time. It's like with any contract. If you're presented with an agreement, you should give yourself the opportunity to negotiate that before entering into it. So that makes logical sense. Sometimes you get some real estate agents that try to bypass the process a little bit for the purpose of securing the sale, but just be mindful as a rule for yourself. Get those documents looked over by a seasoned property lawyer, ideally, And a good property lawyer or a good conveyancer will make time for you. So even you might find like, you know, you found a property that's on a Friday and then auctions the next day on Saturday. A good lawyer or conveyancer will make time for you, whether it's doing a review, you know, over the phone if it needs to be. There's just not enough time to do it any other way. And the advice should always be detailed. So that's the first recommendation, is getting those documents looked over. An agent can always ask you to sign the contract as part of making your offer. But that's okay, provided you've actually had the contract looked over and you've made that informed decision to buy after that. So that's the first tip. The second tip I find is another, you know, tip 101 is getting a building and pest inspection done. So that's a fairly common due diligence exercise that I recommend to clients that they do, ideally before they buy. But if there's not enough time, and provided it's not an option contract, and I'll explain that in a second, you can otherwise try to negotiate to make the contract subject to getting a building and pest inspection report. But the best position is to do it before you buy. The reason for that is just on a practical level. If there's anything, you know, if there's any dilapidation or damage to the property, at least you can use that report as a bargaining tool in some way. If there's anything wrong with the structural integrity, that can inform you to say, okay, maybe I can drop on price and use that in my favor when I'm negotiating commercially on price. So on a practical level, it's really good in that sense, but also it gives you that peace of mind that you know what you're getting into. You know, if it identifies, you know, that there's a pergola at the back, we're not sure if it's got permits, or even if it's got permits, it hasn't been structurally built properly, you can assess what the cost might look like for you if you were to repair it, and you can factor that into your price negotiations. So it's really good to have that report beforehand. The other great thing about having a building and pest report before you buy is if there's any damage to the property before settlement of the property. So let's say you've bought it and then you've done a pre-settlement inspection, you see there's a hole in the wall that wasn't there at the beginning. At least with a building report, it's got lots of pictures and lots of descriptions about the condition of the property. You can compare that against what the condition looks like later on to prove that there's a change, because the onus rests on you to prove that if you're trying to assert that the vendor needs to fix damage before settlement. So having that in place, you know, or having the report in place before you buy really serves you in that scenario as well. And like I said, if you've just got no time, you can try and negotiate just to make the contract subject to getting that building and pest inspection report, again, for that peace of mind. So that's something that I always recommend. The other conditional term that I would suggest to make in the contract is to make the contract subject to formal loan approval. Now, these recommendations to make the contract subject to a building and pest inspection and formal loan approval is available for private sale contracts, particularly, you know, especially in Victoria, because if you buy something at auction, you can't make it conditional on these sorts of safety nets for you. You effectively, you know, you're buying the property as is, but you're buying it under an unconditional contract. So you can't really back out because you didn't like the structural integrity of the property, for example, or you didn't get your loan formally approved. So, you know, when it comes to finance, irrespective of whether it's an auction, or especially if it's an auction property, or if it's being privately sold, get your pre-approval before you buy, because that will ensure that you understand what your borrowing capacity is to determine if you're actually able to afford the property, because you don't want to find that out after you sign. Believe you me, it becomes a messy situation. So that's rule number one. And then second recommendation is to make the contract subject to formal loan approval if it's a private sale. Again, having a seasoned property lawyer will be able to determine how that needs to look like in your contract. If there's no governing provisions in the contract that allow for that, a seasoned lawyer will be able to draft the right sorts of clauses that need to be in the contract to protect you in that way. So that's probably the basic kind of due diligence recommendations I can make. And then the last one, I think, is also making inquiries to the council before you buy. Really important stuff. Time and time again, we see properties, there might be works done, we don't know if they're legal or not. There's no disclosure about any building permits that have been issued, particularly if the works look extensive or structural. A quick call to the council's building and planning department can solve your worries, especially if you do speak to someone that's particularly helpful. Sometimes that's a bit of a 50-50, but assuming you do, you can find out a little bit about, whether permits were issued. I mean, I wouldn't specify the property specifically, just, because you don't want to wake a sleeping beast, so to speak, about what you're buying. But, on a more general level, you can make those inquiries just to say, I'm interested in buying something. It looks to me that there's been a non-load bearing wall that's been moved, or it looks to me there's been a pergola issued, constructed. Can you tell me if there's been any building permits issued in the last 10 years? And if the answer is no, then you've got in your mind, okay, if I buy this property, what it would mean for me is that I would incur that liability for any council fine or council building notice or order issue in the future for me to reinstate the property to its original condition. So just those calls from the council can be the difference whether you buy a lemon or not, in my view. And whether you're actually negotiating on the right price, because that information can inform your decision on what you actually offer as a price based on what it might cost you to remedy those sorts of issues. So that's all my recommendations. I apologize for harping on, but I think that's all things that will put you in good stead when you are buying in the market.
Yeah,
Very good advice, Melissa. Thank you.
I just want to touch on a couple of points, and you raised some really, really good points, Melissa, especially about the building and pest inspection.
Yep.
Because I have personally seen quite a few horror stories where people have or haven't done the building and pest inspection before they buy the property. Maybe we'll see if we can get a building and pest inspector in our episode for the listeners to give some more insights to that. Just before we go, I just had a very quick question to Angelo. Sorry, I didn't cover it earlier. But in regards to from the protection point of view, as you might know, that we have to offer a mortgage protection plan as part of our compliance. And not only that, we want our borrowers to be more protected, right? In the event if unfortunate circumstances were to arise. And a lot of times we get told that, I've got income protection, so if I lose my job, then I'll still get paid and then I can pay off my mortgage. And I was like, okay, are we comparing apples with apples or not really here? What's your take on that?
So if someone loses their job via redundancy, for example, they're not protected. There's no product in the market currently that I'm aware of that offers that protection. There are some sort of slimmed down versions. I know some of the larger banks back in the day had products that if you had an insurance product with them and a loan with them, that they would pay out, I think it was up to 3 months for loss of job, for redundancy, but it was a very strict criteria and very limited as to how much they would pay per month. So there was some in the market. I don't know if people still have them, and if they've still got their loan with them, that would work. But when I'm talking about protecting your income, it's about any medical reasons that you are unable to work. And that's probably one of the biggest things. If you think about work cover or any other protection that you might have, similar in that case, that's protecting you at work. Whereas income protection doesn't matter where you are, doesn't matter where you are in the world, on work, off work, traveling to work, it doesn't matter. If anything is stopping you medically from going to work and producing that income, that's what you're covering. Right. So that's just to clarify that point as well.
Yeah, no, I appreciate it.
But you're right. I mean, it's protecting the mortgage, it's protecting the people living at home, because at the end of the day, that's their home. That's where they're raising their family, or their kids, or that's where they're raising their dogs even. But the point is, it's to make sure that if anything does happen to you, you don't lose the home. You don't want to be in a position where it's reality is either you have to take up another job, and if you haven't got that capacity or that earning capacity or the time wise, then it's not going to happen. Or you have to sell up, and if you don't want to sell the family home, fair enough. You've got to make sure that there is something in place. And there are a whole bunch of other things to consider as well, but that's where these conversations are really important to have with your advisor to make sure, look, am I protected? Do I have enough if anything does happen? Because reality is it goes up. The older you get, the more sort of commitments that you have, the more that you need to insure. And then it gets to that cross point where it just plateaus. And it might plateau for a couple of years, a decade, maybe more. And then you can start taking it down. Insurance isn't there forever. Insurance is there as long as you need it to be there, and you can start taking it down when those commitments and those debts start coming down as well. And just think of it like, if you can't afford to travel, you can't, if you can't afford to have the insurance, you can't afford to travel. It's the same idea.
Yeah, no, I get it. Yeah, it's a good point.
There's a lot of stuff that we've covered today, and it's been so valuable. So to our viewer and listener, I'm sure that you'll walk away from this episode having taken a lot from, income protection, finance, commercial risk, and of course legal risk. So it's been a pleasure having all of you present at today's episode. And Angelo, thank you so much for coming on board. That has been so enlightening, and I hope people can start taking out a bit of life insurance for themselves. Because if you're the breadwinner of your house, or if you're the one that's responsible for paying the mortgage, and you need to work, having that extra peace of mind with life insurance is going to be really essential if something went wrong.
We're here to make it sound a bit sexy, aren't we? Thanks for having me. I really appreciate it.
Thank you.
Thank you.
And so we're bringing it to a close. Thank you to our listener for listening, and we'll see you next time at Wealth from Walls.
Fantastic.
Thank you.
Thank you so much.
Yeah, everyone.